What is a Japanese candlestick? A Japanese candlestick represents a battle between buyers and sellers. Nothing more, nothing less. Each candle shows four things: where price opened, where price closed, the highest price reached, the lowest price reached. That's it. But inside those four prices is human psychology. If buyers win, the candle closes strong. If sellers win, the candle closes weak. If neither side wins, the candle shows uncertainty. That uncertainty is where money is made, because uncertainty comes before big moves. Now let's talk about why U.S. traders must care about this. Why candlesticks matter in U.S. markets. U.S. markets move fast. News hits instantly. Algorithms react in milliseconds. Retail traders panic. Institutions stay calm. Candlestick patterns help you see who is in control, not what CNBC says, not what Twitter says, not what Reddit says. Price never lies. In candlesticks are price in its purest form. This is why Japanese candlestick patterns work on Apple stock, Tesla stock, SPY, QQQ, options contracts, crypto coins, different assets, same psychology. Now let's break down the most important concept before learning patterns. Candle body versus wick. This is where most beginners mess up. The body of the candle shows commitment. The wick shows rejection. Long body, strong conviction. Small body, indecision. Long upper wick, buyers tried and failed. Long lower wick, sellers tried and failed. Every wick is a lie exposed. Every body is a decision made. Once you understand this, patterns start making sense. Now let's talk about the first powerful signal every U.S. trader must know: the Doji, the candle of indecision. Doji is one of the most important candles in trading, and it's also one of the most misunderstood. A doji forms when price opens and closes at nearly the same level. Buyers push price up, sellers push price down. Neither side wins. The market pauses. This pause is critical because strong trends do not reverse without hesitation, and the doji represents hesitation. In U.S. stocks, doji candles often appear at market tops, at market bottoms, before earnings moves, before trend reversals. But here's the mistake. A doji by itself means nothing. Context is everything. A doji after a strong uptrend? Warning sign. A doji after a heavy sell-off? Potential reversal. Professional traders don't trade the doji. They prepare after the doji. That preparation is where edge is built. Now let's step into something even more powerful: the hammer, the market's lie detector. If there's small body at the top, long lower wick, little to no upper wick, but the psychology behind it is massive. Here's what happens during a hammer. Price opens, sellers attack hard, stops get hit, weak hands panic, then suddenly buyers step in aggressively. They absorb all selling, they push price back up, the candle closes near the top. That long lower wick, that's sellers getting trapped. In U.S. markets, hammer candles often appear at support levels, at pre-market lows, after bad news. They tell you something critical. Selling pressure is weakening. But again, context matters. A hammer in the middle of nowhere is useless. A hammer at key support, that's where professionals pay attention. Now let's flip it. The hanging man. Same shape, different meaning. This is where beginners lose money. The hanging man looks exactly like a hammer. Same shape, same structure. But the location changes everything. A hanging man forms after an uptrend. This candle tells you buyers are getting tired. Sellers are testing the market. Smart money is distributing. In U.S. stocks, hanging man candles often appear near all-time highs, before earnings dumps, before trend reversals. Same candle, opposite meaning. This is why candlestick patterns are about story, not shapes. And we're just getting started, because next, we're diving into 2 candle patterns that institutions love. In part 2, you'll learn why the bullish engulfing pattern traps short sellers, how the bearish engulfing pattern signals distribution, and how US traders use these patterns to time entries with precision. Stay sharp, because now you're starting to see what most traders never will. Now that you understand how single candles reveal fear and strength, it's time to level up, because the real money in US markets is made with multi-candle patterns. These patterns show transition from fear to confidence, from confidence to greed, and from greed to collapse. Institutions don't guess tops and bottoms. They wait for confirmation, and 2 candle patterns give that confirmation. The first pattern every US trader must master is the bullish engulfing pattern. This pattern appears after a downtrend or a pullback. The first candle is bearish, showing sellers still in control. The second candle opens lower or near the first candle's close, and then buyers step in with force. Price rallies and completely engulfs the previous candle's body. This is not random. This is short sellers getting trapped. This is smart money absorbing sell orders. In US stocks, bullish engulfing patterns often appear near daily support, VWAP, moving averages, or previous demand zones. The psychology is simple. Sellers thought the downtrend would continue. Buyers said no. When you see a strong bullish engulfing candle with high volume, that's institutions showing their hand. But professionals don't buy blindly. They wait for confirmation on the next candle or enter near the midpoint of the engulfing candle for better risk. Now flip the script. The bearish engulfing pattern is the market's warning siren. It forms after an uptrend. The first candle is bullish, optimism is high, retail traders are buying breakouts. Then the second candle opens near the highs and sellers slam the market down, engulfing the previous candle completely. This is distribution. This is smart money selling into strength. In US markets, bearish engulfing patterns often show up near resistance, pre-earnings hype, or after parabolic runs. This is where amateurs buy and professionals sell. The candle doesn't just show selling, it shows rejection. It tells you buyers tried and failed. Next comes one of the most powerful reversal structures ever created, the morning star. This is a 3-candle pattern that signals a shift from bearish control to bullish dominance. The first candle is strong bearish momentum. The second candle is small, showing indecision. This is the market pausing. The third candle is strong bullish momentum that closes deep into the first candle's body. This is confidence returning. In US stocks, Morningstar patterns often form after panic selling, bad news, or market overreactions. They mark the moment when fear peaks and opportunity begins. The opposite is the evening star, and this pattern destroys late buyers. The first candle is strong bullish momentum. Everyone is bullish. The second candle is small. Hesitation creeps in. The third candle is a strong bearish candle that closes deep into the first candle. This is the moment optimism dies. In US indices and large cap stocks, evening stars often appear near market tops, before pullbacks or full trend reversals. Now here's the rule most YouTube gurus won't tell you. Candlestick patterns do not work in isolation. They work best at levels: support, resistance, trend lines, high volume areas. When a candlestick pattern aligns with structure, probabilities increase. This is how professionals trade. They wait. They let price come to them. They don't chase, they react. And now let's talk about one candle that traps more US traders than any other, the inside bar. An inside bar forms when a candle's high and low stay completely inside the previous candle. This represents compression. Volatility is building. Energy is loading. Inside bars often appear before breakouts or breakdowns. In US markets, they are common before news, earnings, or major sessions like the New York Open. The direction of the breakout matters more than the inside bar itself. Professionals wait for expansion after compression. That expansion is where money flows fast. At this point, you should realize something important. Candlestick patterns are not magic. They are evidence. evidence of who is winning the battle, evidence of who is losing control. And in part 3, we're going even deeper. You'll learn advanced patterns like the piercing line, dark cloud cover, and how institutions use fake breakouts to trap retail traders using candlesticks. Once you see it, you can't unsee it. And once you understand it, you'll never trade the same. Now we enter the zone where most retail traders get confused and professionals get paid. This is where candlestick patterns stop being signals and start becoming weapons. In US markets, advanced candlestick patterns are used to trap emotion. They are designed to look bullish when distribution is happening and bearish when accumulation is taking place. The first advanced pattern every serious trader must understand is the piercing line. This pattern forms after a downtrend. The first candle is strong bearish momentum. Fear is high. The second candle opens lower, making sellers confident, but then buyers step in and drive price upward, closing more than halfway into the previous candle's body. This is not just buying, this is control shifting. In US stocks, piercing line patterns often appear near demand zones, daily lows, or after gap down opens. They tell you selling pressure is being absorbed, smart money is stepping in quietly, while retail is still scared. The bearish cousin of this pattern is the dark cloud cover, and this one is deadly near market tops. It forms after an uptrend. The first candle is strong bullish momentum. The second candle opens higher, creating excitement. Then, sellers aggressively push price down, closing deep into the previous candle's body. This is a warning shot. It shows buyers losing strength and sellers taking over. In US markets, dark cloud cover patterns often appear before pullbacks, earnings reversals, or trend changes. Now let's talk about one of the most deceptive patterns of all, the tweezer top and tweezer bottom. These patterns form when two candles in a row have nearly the same high or the same low. A tweezer top shows repeated rejection at a high. Buyers try twice and fail. This is distribution. A tweezer bottom shows repeated rejection at a low. Sellers try twice and fail. This is accumulation. In US stocks, tweezers are powerful at key levels like previous highs, lows, or psychological levels such as whole numbers. They reveal invisible walls where institutions are active. Next comes the most misunderstood candle in trading, the Marubozu. A Marubozu candle has little to no wicks. It shows pure aggression, full control by buyers or sellers. In US markets, bullish Marubozu candles often appear during breakouts, news releases, or trend continuations. Bearish Marubozu candles appear during panic selling or market crashes. The mistake beginners make is chasing these candles. Professionals wait for the pullback after the Marubozu to enter with low risk. Strength invites patience, not FOMO. Now let's expose the truth about fake breakouts. Institutions love using candlesticks to trap retail traders. A fake breakout often begins with a strong candle breaking resistance. Retail buys the breakout. Then price immediately forms rejection wicks, bearish engulfing patterns, or evening star structures. This is called a liquidity grab. Candlestick patterns reveal these traps before indicators ever do. Long upper wicks near resistance means smart money is selling into breakout buyers. Long lower wicks near support means smart money is buying into panic selling. This is the real edge. Finally, you need to understand candle sequencing. One candle means nothing. 2 candles suggest intent. 3 candles confirm direction. Professionals read candles like sentences, not letters. They watch how price reacts after patterns, not just the pattern itself. In US trading, patience is the difference between consistency and chaos. And now you're ready for part 4, the final piece. This is where everything comes together: risk management, confirmation, and how to actually trade Japanese candlestick patterns in real US markets without gambling. This is where traders stop hoping and start executing with confidence. This is the final piece, the part most traders never reach, because this is where Japanese candlestick patterns stop being educational content and start becoming a real trading framework. Everything you've learned so far only works if you understand how to apply it with discipline in live US markets. Candlesticks do not make you money. Decision-making does, and decision-making comes from structure, confirmation, and risk control. First, you must understand confirmation. No professional trader enters a trade just because a pattern appears. They wait to see what price does next. A bullish pattern followed by strong follow-through shows acceptance. A bullish pattern followed by hesitation or rejection shows weakness. In US stocks, confirmation often comes from the next candle closing in the direction of the pattern, or from volume expanding in the same direction. Volume is the fuel. Candlesticks show direction. When both align, probability increases. Next comes location, the most important factor of all. A perfect candlestick pattern in the wrong place is useless. A simple pattern at the right level can be powerful. Support, resistance, previous day highs and lows, VWAP, trend lines, and key psychological levels are where candlestick patterns matter. Institutions do not trade randomly in the middle of ranges. They execute at areas of interest. When you see a hammer at daily support, a bullish engulfing at VWAP, or a morning star after panic selling, that is context meeting confirmation. That is where trades are planned, not forced. Now let's talk about entries. US traders lose money because they chase candles. Professionals let price come back to them. Instead of buying the high of a bullish candle, they wait for a pullback into the candle's body. This reduces risk and improves reward. Candlestick patterns give you a zone, not a single price. Stops are placed beyond the pattern, not randomly. If a hammer's low is broken, the idea is invalid. If a bearish engulfing's high is taken, sellers lost control. Candlesticks define invalidation clearly, and that is a gift most traders ignore. Risk management is what keeps you in the game. Even the best candlestick setup fails sometimes. Professionals accept this. They risk small to win big. 1 to 3, 1 to 5. They never risk large amounts on a single idea. In US markets, consistency beats excitement. One good trade a day beats 10 emotional trades. Candlestick patterns help you wait. Professionals align multiple time frames. They look for higher time frame direction and lower time frame entries. For example, a daily bullish engulfing combined with a 15-minute pullback pattern creates precision. This is how institutions scale in. Retail traders jump in. Professionals build positions. Another critical concept is market conditions. Candlestick patterns behave differently in trends versus ranges. In strong trends, continuation patterns like bullish Marubozu pullbacks and inside bar breakouts work best. In ranges, reversal patterns like tweezers, hammers, and engulfing candles dominate. US markets rotate between expansion and consolidation. Candlesticks tell you which phase you are in. Now let's kill one dangerous myth. There is no single best candlestick pattern. Anyone selling you that idea is lying. The edge comes from combining patterns with context, structure, and discipline. Candlesticks are language. You must learn to read sentences, not hunt for one word. And finally, mindset. Japanese candlestick trading rewards patience, not prediction. You are not here to guess the future. You are here to react to behavior. Price shows its hand. Candlesticks expose intention. Your job is to listen. Most US traders fail because they want action. Professionals wait for clarity. When clarity appears, they act without emotion. This is why candlestick trading has survived for centuries. Human psychology does not change. Fear looks the same. Greed looks the same. Panic looks the same. Only the charts change. And now you see it. The market is no longer random candles moving up and down. It is a story unfolding in real time. Every wick, every body, every close is information. And once you learn to read that information, you stop being a gambler and start thinking like a trader. This is not the end. This is the beginning, because the charts you look at tomorrow will never look the same again.